lot to talk about. Of course, the market's volatility certainly continued, but we really want to start off with what happened with the labor report that came out on Friday morning. Certainly, we saw an ADP report that did not connect with what came out of the payroll report. And what shockingly to me, Derek, was before the report was listed and given to us, the White House came out and said, expect a really lousy report. Of course, the payroll comes from the government, and the White House certainly was not on the same page.
Right. I guess they read too much into the ADP report, which showed a loss of 310,000 jobs. But what we saw was actually a whopping 467,000 new jobs in January and an upward revision of the prior 2 months of almost 800,000. So what it really says to me is Omicron really did not affect the strength of the labor market.
Now, we have seen adjustments as the time goes on. And really, I thought that the more important part was going to be the adjustments going backwards versus the information that they got, maybe not even in real time, because these reports are really just surveys. And who they surveyed or when they surveyed certainly could affect that report.
Well, and the other thing that may have affected it too is typically what you see is seasonal workers get laid off after the holidays. But because labor's in such a shortage, employers decide to hang on to those folks so that when you annualize it out, it is actually seen as a job gain as opposed to a job loss.
Right. And one of the things I think you have to take away from it is if the job report is good, it certainly gives the Fed more runway because, of course, we certainly talked about inflation and everything that was going into it. It was shocking to us is that the Fed did not see the inflation coming with supply chain issues, obviously with labor shortages, with raw material shortages, and now we expect an inflation report next week, and it's going to be even worse than what we've seen before because of rising energy prices.
Right. We've seen a sharp rally. The WTI was trading at $92 on Friday. The odds now of a 50 basis point hike in March, which I know you don't believe will occur, are now up to 34%. Certainly gives the Fed ample room to do so, given the strength of the economy. But we'll be seeing that CPI report next week and how the Fed will react to the data.
And the reason why I say that, Derek, is that generally the Fed has been good for a long time about telegraphing what they're going to do. And they certainly telegraphed that they were going to taper and then address inflation later down the road. That's the reason why they haven't said anything or led me to believe, my personal opinion, that it would be 50 basis points unless what we see next week is so hideous of an inflation report that they have to.
Well, and in the UK, we saw that the EU did not raise their interest rates, but the UK central bank did raise their interest rates by 25 basis points, but it was a 5-4 majority. 4 of those members wanted a 50 basis point hike.
And so if they have this hike, and by the way, this is a really important piece, when other countries are raising rates, or even like, for example, China lowering rates, and we're doing something opposite, that affects the U.S. dollar. And when the dollar gets affected, Derek, it certainly hurts companies that ship abroad.
Right. I mean, it makes their products more expensive. But basically, the dollar, historically, when the Fed begins a tightening cycle, the dollar tends to go lower. And that's something that most people wouldn't expect. And if that were to occur, that just makes overseas investments that much more attractive, which is why we constantly advocate having a balanced portfolio, because equities overseas are much less expensive than U.S. stocks and are far less concentrated in technology, which I think is an overowned group.
And in the last 30 seconds, we have been talking about the 10-year Treasury, and 10-year Treasury got to 1.92 on Friday, towards the 2% that we had talked about. What is interesting is there is the difference between what the Fed can do and what the overall markets are doing, and there seems to be a disconnect. The last thing I think the Federal Reserve will want to do is what's called inverting the yield curve, and we're going to talk about that, Danny, when we get back.